this is going to be a really cool video. We're going to talk about something known as credit spreads. Let's jump into it. So right here we have credit spreads. Let's break it down into the two words. Credit means income, as in this is money coming into your pocket. And spreads we're going to talk about in just a little bit, and with an example this will make a lot of sense. The first credit spread we're going to talk about is known as the put credit spread. You guys have seen this type of chart a million times, right? Let's say stock's at $100 and then you would sell a put option at $95 strike price. And basically if the stock stays above 95, you get to keep the money. If it goes below, you kind of lose money, as in you become obligated to buy 100 shares at $95. So that's the previous way we used to look at this. What if you don't want to own a stock and you just want to collect the income? Well, that's when credit spreads come into place. So you could go ahead just selling a $95 strike price, knowing that, hey, as long as the stock stays above 95, you'll be fine. But if it goes below, you become obligated to buy 100 shares. If you had just sold a naked put option, you would be exposed to all this risk, right? The stock could be trading at $70 and then you would have to have taken a $25 loss just because, again, you're not trying to buy the stock, you just ended up accepting the obligation to buy the stock, and because it's a naked position you would lose at least $25 per share, but of course you still get to keep the premium, so it's going to be slightly less than that. So instead of taking on all this risk, what if you bought yourself insurance at the 90 strike price? So let's look at this over here. You sold a $95 strike put option. Let's say you collected $1 from that. Again, using purely arbitrary numbers right here. But then you buy a 90 put option, and so then you pay, let's say, 40 cents. So you collected $1, but then you paid 40 cents and you profited 60 cents for this spread. So basically what happens is if the stock stays above $95, you get to keep this entire 60 cents. Again, that's per share. Each contract is for 100 shares, so this is $60. But if the stock goes below 90, well, because you bought protection, your max loss is just the width of the strikes plus the premium. So your max loss is $5 minus the 60 cents, which equals $4.40. So with the put credit spread, in this hypothetical example, you are risking $4.40 to make 60 cents. Again, these are hypothetical numbers and I'll show you actual numbers in future videos. With put credit spreads, use it when you're bullish or neutral on a security and you don't want to actually take assignment of the stock. In future videos, we're going to talk about actual entries and exits, but I just want to teach you about the principles of the strategy. Again, it starts with just selling a put option, but then you end up buying protection with a lower, deeper out of the money put option. Now when you do this, you're able to protect your downside losses. So that way you won't necessarily be stuck with a stock as long as you don't hold it to expiration. Again, we'll talk about this in future videos. In the next video, let's talk about call credit spreads.